All right, with the question of whether too big to fail still looms, we thought we'd take the pulse of the banking system. Joining me now is Bert Ely, president and founder of Ely Co, a monetary policy consulting firm that monitors the banking and thrift industries. Ely, an early predictor of the savings and loan crisis and the non-crisis in commercial banking in the early 1990s, has specialized in deposit insurance and banking structure issues for nearly 30 years. Bert, welcome.
Glad to be here.
Thanks so much for coming on.
Glad to be here.
So what's your take on the state of the banking system now? How does it compare with, say, a year ago, 2 years ago?
The banking system has steadily strengthened over the last few years. There's still some problems in the system. We're still getting failed banks, but the number of bank failures peaked in 2010, dropped significantly last year, and are down again this year. The banks have worked through a lot of their problem loans. Many of the banks have been able to raise capital. So overall, the banking system's in much better condition than it was a few years ago.
Let's talk about the balance sheet situation. How much progress have banks made in repairing those balance sheets? How many toxic assets are on there? To what extent do these home equity lines of credit for first or even second mortgages that have gone bad, are those still weighing on the banks?
They're still out there, but again, the problem is not as bad as it was a couple of years ago, and the banks still, a number of banks still have some problems that they have to work through. A lot depends, particularly for the smaller banks, what part of the country they're in. Those banks that, for instance, are in Florida or Georgia or areas of California, still, many of those banks will still have problems. Other parts of the country where they didn't have such a serious housing finance problem, they're basically in better shape.
So we're 4 years after the financial crisis, and there's been some massive deleveraging. We're starting to see some demand for loans. The Fed has said, outside of mortgages, that demand for autos, for example, or credit cards has picked up. Are we at an inflection point for lending?
I don't think we're quite there yet, and the reason why is we still have sluggish economic growth. The unemployment rate is coming down slowly, so I don't think we're to the inflection point yet. I mean, things have been picking up in some areas of lending, but home mortgages, for instance, are still a real problem. A lot of people are underwater on their mortgages. They're not able to refinance. We have a lot of backlogs among the mortgage companies in terms of the time it takes to originate a new mortgage. So we're still not there yet, but it's slowly, steadily getting better.
So is credit too tight or as tight as it should be to aid the economic recovery now, and especially on the mortgage side, as you mentioned?
Well, the problem in the mortgage area is a lot of homeowners are not able to refinance into lower interest rate mortgages or to deal with a past due mortgage because house prices are still down. They may have impaired credit quality. And so the housing finance continues to be a real problem, even though mortgage interest rates are at record lows.
What would happen if the banks were forced to repurchase bad loans from Fannie and Freddie? Do they have enough capital on hand to absorb those losses?
I would say by and large they do, but on the other hand, the banks are going to be fighting very much against that, and so I'm not sure, how many loans will end up actually getting repurchased. Of course, there have been some, but I don't think that it's something that's going to be that significant, and I think the banking industry could survive it.
What impact will the implementation of Dodd-Frank have on the banking system? Do you think it will make the banking system safer?
No. No, I think that Dodd-Frank has been vastly oversold for what it'll do. And the biggest concern about Dodd-Frank are some of the unintended consequences. A lot of smaller banks, for instance, are having a difficult time complying with the regulations because of the expense of doing so. And then they're particularly concerned about some of these consumer regulations that will be coming out. They may actually have a negative impact on banking by making it harder for banks to lend, and may even cause some banks to get out of certain types of lending because of how onerous these regulations are going to be.
What are the biggest risks that are facing the banking system right now?
Well, probably the biggest risk is if the economy were to fall back into a recession. And to some extent that may be out of our control if the problems in Europe worsen and those problems spill back into the U.S. economy. That's a very real risk.
Are U.S. banks being negatively impacted by the European debt crisis right now?
At this point in time, no. But there could be a negative impact If Europe's problems spill back into the U.S. economy and weaken it, then I think we would see some increased problems in the U.S. banking system.
A lot of focus has been put on the larger banks, but how are the community banks and the regional banks faring?
Well, I think the community banks are, again, many of them always were in good shape, didn't get into that much trouble. I think a lot of the community banks they're working through their problems, but at the same time, they're running into issues of complying with all the regulatory requirements of Dodd-Frank. Dodd-Frank has spawned almost 400 regulations that the regulators are having a hard time getting implemented, and then the banks are going to have, particularly the smaller banks, going to face a real challenge in terms of trying to comply with those regulations.
Is too much risk concentrated right now in the top 5 banks? Do you think that the top 5 banks should be broken up?
No. First of all, no one has a good idea about exactly how to break them up. I think they're doing some that market forces are forcing them to downsize to some extent. But I'm not horribly concerned about the risks in those banks at this time. Again, they have strengthened themselves a lot in recent years. And even with it's interesting with the J.P. Morgan Chase flap, the loss of several $1 billion, that only puts a dent in 1 quarter's worth of earnings. It's had no meaningful effect on their capital, and they're able to handle it okay. So I'm not overly concerned about that this time, nor do I think it's really practical to talk about trying to break them up.
All right, Bert Ely, thank you so much for your time and insight.
All right, glad to be here.